Hello and welcome. Today, we are going to pull back the curtain on one of the most powerful and, let's be honest, most misunderstood tools in the entire world of finance, derivatives. Now, that word might sound complicated, but I promise you the basic idea is at the heart of everything, from the price of your morning coffee to the cost of an airline ticket. So, let's dive in and demystify this thing. So let me start with a question for you. What on earth could possibly connect a cocoa farmer in West Africa, a huge airline trying to budget for jet fuel, and a trader speculating on the price of gold? Well, the answer is a really clever financial tool that was invented to manage the one thing that keeps just about every business owner up at night: uncertainty. But, before we can really get our heads around the solution, we have to understand the problem itself. And it all starts with the fundamental nature of markets and, you guessed it, risk.
We all think we know what a market is, right? It's a place where buyers and sellers meet up to exchange things of value. But here is the mind-bending idea that's key to everything we're talking about today. You can also buy and sell risk itself. I'm serious. The uncertainty about what something will be worth tomorrow can be packaged up and sold by someone who doesn't want it to someone who's willing to take it on.
And that, right there, is the biggest challenge of all. If you're that farmer, you have no idea what you'll get for your crops in a few months. If you're that airline, you have no clue what your single biggest expense, fuel, is going to cost next quarter. That kind of uncertainty makes planning for the future almost impossible. Okay, so how do you solve a problem like that? How do you fight back against the uncertainty of the future? Well, you invent a special kind of contract, one specifically designed to lock in a future price today. And that special contract is called a derivative. Let's make this really simple and go back to our farmer. Okay, so imagine a cocoa farmer. Her absolute biggest fear is that by the time she's ready to sell her harvest, the global price of cocoa will have crashed and she'll lose a ton of money. Now, at the very same time, you've got a big chocolate company, and they have the exact opposite fear. They're terrified the price of cocoa will skyrocket and it'll become way too expensive to make their chocolate bars. See? Two sides, opposite risks. So what do? They make a deal. They create a contract together where she agrees to sell her cocoa to them in 3 months, but, and this is the magic part, they agree on the price right now. Let's call it $3,000 a ton. It doesn't matter what the market price does over the next 3 months, their price is locked in. Just like that, they have both used a derivative to get rid of their biggest risk. And this shows you exactly how it plays out. It's pretty brilliant. If the actual market price in 3 months drops to $2,500, the farmer is celebrating. She still gets her locked in $3,000. The chocolate company is paying more, but that's the deal. On the other hand, if the market price soars to $3,500, now the chocolate company is breathing a huge sigh of relief. They only have to pay $3,000. See, the point for them wasn't to gamble and make a killing. The point was to get certainty so they could actually run their businesses. And this perfectly lays out the two completely different personalities of derivatives. What our farmer and chocolate company did is called hedging. They were using a contract to protect themselves, to get rid of risk. But a speculator can use the exact same type of contract to do the total opposite. They jump in and willingly take on that risk, basically making a bet on which way they think the price is going to move, all in the hopes of turning a profit. Now, the word derivative doesn't just refer to one single thing. It's actually a whole category, a whole toolkit of financial products. So let's take a quick look at some of the most common tools you'll find in that kit. Okay, so that contract between our farmer and the chocolate company, that's a textbook example of a forward contract. It's a totally private, customized deal between two parties. They get to decide on all the little details, the exact price, the exact date, the exact amount. It's super flexible, but it's all built on the trust that the other person is going to hold up their end of the bargain. Now, a futures contract is very similar, but with one massive difference. It's standardized, and it's traded on a public exchange, kind of like the stock market. This means the contract size, the delivery dates, all of that stuff is already set. It's not custom. And because of that, they're really easy to buy and sell with anyone in the world. And this table just lays out those trade-offs perfectly. Forwards give you all that wonderful flexibility, but you're facing something called counterparty risk, which is just a fancy way of saying there's a risk the other guy might not pay up. Futures, on the other hand, are rigid and standardized, but because a big exchange is in the middle guaranteeing the deal, that counterparty risk is way, way lower. Options are a whole other level of cool. When you buy an option, you're not buying a thing. You're buying the choice to do something later. You get the right to buy or sell at a price you lock in today, but you're not forced to do it. You're not obligated. So what does that mean? It means if the market moves against you, you can just walk away. The only thing you lose is the fee you paid to buy the option in the first place. It's a really powerful way to limit your potential losses. All right, let's shift gears and talk about a very modern and super accessible type of derivative, one that is built almost entirely for speculation. We're talking about the contract for difference, or as most people call it, a CFD. So, with a CFD, forget about cocoa beans or barrels of oil. None of that is involved. A CFD is just a simple contract you make with a broker. You're simply agreeing to exchange the difference in an asset's price from the moment you open your position to the moment you close it. That's it. And this, right here, is the single most important thing you need to understand about CFDs. You never, ever own the stock, or the gold, or the currency. You are purely 100% speculating on its price movement. It is all about the change and value, and absolutely nothing else. And that makes them really different from those more traditional derivatives we talked about. CFDs typically don't have any expiration dates. They're always settled in cash, so no, you don't have to worry about a truckload of wheat showing up at your house. And they offer incredibly flexible contract sizes, which is what makes them so accessible to so many people. And that accessibility, well, that brings us to the most critical, the most important part of this entire explainer. Because CFDs are almost always traded with a tool called leverage. And leverage brings with it both immense power and truly immense danger. So what is leverage? At its core, leverage is just a loan from your broker. It lets you control a much, much larger position in the market than you could with just your own money. But the key word here, the word you have to remember, is magnifies. It acts like a magnifying glass. It makes your potential profits bigger, sure, but it also makes your potential losses bigger by the exact same amount. So a pretty common leverage ratio you might see is 20-1. Now, what does that actually mean? It means for every single dollar you put into a trade, your broker is letting you control $20 worth of that asset on the market. You can probably already see how powerful that could be. But what's the real-world impact? What does this actually do to the money in your account? Well, the results can be absolutely staggering. Okay, just look at this. With 20-1 leverage, if the market moves just 5% in your favor, you double your money. That's 100% gain from a tiny market move. Incredible, right? But here's the other side of that coin. If that same market moves just 5% against you, you've lost everything. Your entire investment is completely wiped out. That's the brutal, unforgiving math of leverage. So what's the bottom line here? Look, derivatives are incredibly powerful and fascinating tools, but they are not a game. Especially when leverage gets involved, it is absolutely crucial that you understand exactly what you're trading, that you have a rock-solid plan for managing your risk, and of course, the golden rule of trading always applies: never, ever trade with money you can't afford to lose. So that really leaves us with a final question, one only you can answer. Are these powerful tools, with their incredible potential, worth the undeniable risk?